Assalamu alaikum, and welcome to Market Talk with Musaffa. You're welcome. Your weekly deep dive into halal investing, where faith meets finance. We're on a mission to halalify investment world, one stock at a time, inshallah. And today's topic is peace, pause, or pressure. Three scenarios from U.S.-Iran talks. And then, right now, markets are trying to price something that is not clear yet, right? We don't know what's going on. Talks are happening, headlines are shifting, and at the same time, the Strait of Hormuz remains closed, keeping the pressure on oil, of course, and supply chain and global markets. So investors are left asking the questions about, do we get the breakthrough from these talks? Do things drag on? Is the negotiation going to continue for a very long time, that it affects still the market? Or does volatility return to in full force if the escalations return and war return, and then we don't know where we're going to be left off from there, right? So those are the investors asking questions themselves. So today's we're breaking this down through three realistic scenarios, and more importantly, what each could mean to you, to the market, to global market, how investors should position themselves, especially those who are building portfolios aligned with the Sharia principles. Again, at the beginning, I always put this disclaimers because we're SEC, US SEC regulated entity. So but the registration does not imply endorsement, and this session is for informational purposes only. Should not be considered as investment advice or recommendation to buy or sell any stocks or securities or ETFs. The discussion is tailored to your individual. It's not tailored towards your individual financial situation. Please do your own research or consult with a qualified advisor. The views of me and any speaker who joins these are our own and may not be representative or views of experience of others. All investment involve risks, and past performance does not guarantee the future results. And as usual, we have our wonderful guest, Shahjahan Bakhtiar. He's is my best speaker that I always bring him in on the very, very interesting topics. Alhamdulillah. We will try to diversify, inshallah, and bring some other guests where maybe we will be with Shah interviewing others, or myself. It's based on our schedule, but we try to bring new, fresh faces that you can learn from experts, inshallah. But today's topic is very interesting, so we'll try to break it down with Shahjahan going through these three scenarios, right? So, and then these three scenarios, before I start asking each of them, basically the scenarios are if deal happens quickly and then we are put back to the situation where we were before the war, right? If any damage has been done, and then how it's going to be taken care of, it's a separate topic. But if the deal goes through quickly and it is successful, and then we agree to we put back to situation where we were before the war. Now the second scenario is where the war is going to the negotiations is going to be dragged for more than 2-3 weeks, and then during that time, Strait of Hormuz still remains closed because I don't think Iran is going to be opening it because they want to keep it as a leverage during the negotiations. So what happens then? Because there is still pressure, even 2 weeks could be too long. And then third scenario, of course, the groom scenario, the one that we don't want to see. The war resumes, and then it escalates and then drags for a couple of months or even longer. We don't know. But what happens in that kind of scenarios? So Again, we will go through one by one with Shahjahan, but before I do that, I always give a few words for Shahjahan to share his thoughts, and then welcome guests, anyone, sorry, welcome the audience, and whoever is listening us from any parts of the world. Yes, Shah.
Yeah, assalamu alaikum to all of our viewers and to you as well, brother Anat. Thanks for having me again. Yeah, hugely important issue, and honestly one that ties into several of our last market talks. So anyone who's been watching, it's very relevant. It's very relevant to everybody, but you'll be very well situated if you've seen our prior uploads as well. I encourage you to go back and watch those. So has been a developing story. It's of central importance for the global economy and for every country's economy. So yeah, excited to get into it.
Absolutely. Thank you so much. And then to our audience, as usual, we ask, please stay active, and please share where you're joining from. We want to fill this vibe of uh, talking to international audience, right? To our audience who are joining from all different countries. If you just leave one answer saying that where you joining from which country you're joining from, that would be very nice to see. Last time we had people joining from all parts of the world. We had people from Italy, we had people from South Africa, we had people from India, we had people so many places. Please leave your in the chat, in the comment section, where you're joining from, and we will bring it up, inshallah, to the screen. And if you have any other questions about related to this topic, that's three scenarios that we will be discussing with Shah. If you have any questions, please leave those questions, and we will do our best to answer those questions, inshallah. And thank you so much. So I guess we'll start it, Brother Shah. So let me let me have those. So the first scenario, right, which is deal happens quickly. Um, let's say next 2 3 days, parties agree on all terms, which is a little bit um probably unrealistic in 2 3 days, but let's say even a week. But the discussions are positive, all the good things are changing. The Strait of Hormuz is agreed to open. The world sees the life of this 20% of the oil oil and gas uh stripped away from the flow, so that we put it back, and then we come back to that normal life before the war, right? Before the conflict. So in that case, um, uh, what do you think? How the market is going to reset quickly, and then has some of the damage already been priced into this, and then would the supply normalizes quickly, and how quickly that is going to happen?
Great question. So yeah, in the situation where let's say peace is reached, and then it's a question of like how long until the peace is reached, right? So if peace is reached tomorrow, that's different than if there's an agreement that's reached 3 weeks from now, like you indicated as well. Um, but I'm afraid that I believe to some degree a bit of that price has been baked in. There's some structural changes which are going to come that I think already have come with what's happened that I think are going to be baked in. Already, if you look at sort of global macro reports, so these are research reports that hedge funds and banks, investment banks put out every quarter, where they're like, let's look at the global economy. Here's what we think is going to happen. Here's the situation in labor markets, interest rates, inflation around the world. So already, if you look at reports from November, December, and early January 2025 to 2026, a lot of these institutions were thinking, okay, I think inflation is actually structurally at a higher level. So central banks, for example, the United States Central Bank targets a 2% inflation rate. It's been elevated, especially since COVID, and it's had a hard time bringing it back down, but that's still the target, and everybody believed eventually we'll get back to 2%. But some research, for example, KKR came out and said, we believe it's structurally higher. Like it can't go lower than like 2.5%, for example. So that was before this crisis even began. We just had a massive shock in terms of the physical actual infrastructure in the area, in the oil supply, a major shock lasting weeks that has been pushing up inflation, that has been pushing up oil prices. And even if peace comes, a negotiated settlement is reached, you will see prices go down. You will see inflation maybe temper, like it won't raise as aggressively as it would if the war kept on going, and we'll talk about that in the next scenario. But I think to some degree that it's permanent. I think global economies are going to see that inflation rates are going to be higher than they were going to be otherwise. And one reason for that is, like we said, with things like with commodities, especially like oil and gas, it's not just numbers on a screen, right? It's not just the financials. It's not just the companies going up and down when you invest in them. It's actual a physical product with physical infrastructure. And a lot of that physical infrastructure is damaged. Some of those will take a few months to recover. There's a facility for gas in Qatar which could take 3 to 5 years to fully recover. And what
I
that
really
means
heard
is
about that. Yeah.
exactly. So, and what that means is that the supply of oil and gas, even if the war ends completely, it's going to take a while to get it back to where it used to be. What that means is the supply is going to be dampened for a while, no matter what, even if the war ends. And if the supply is dampened, what that's going to mean is that the prices will stay high. They'll come down from the peak they're at, but they'll be higher than they were before the war started. And then another thing to consider is the details of any settlement, right? So, for example, there's a lot of talk about perhaps charging a fee for ships going through the strait. If that happens also, if it becomes more costly to ship oil and gas through the strait, to ship cargo through the strait, then for those shipping containers to make a profit, they'll have to charge more money. So that's also another mechanism through which there's just going to be a higher push for more inflationary. It's another inflationary pressure that way as well. So I think even if we see peace, which inshallah we do, there's a negotiated settlement, hopefully that leads to peace in the broader region and the world. But even if we do, I think inflation is probably here to stay.
Okay. Great. Thank you. Thank you going a little bit in deep because I was going to ask on each of them. So you covered a lot about inflation and went in deep. But I want you also to look into the oil prices in the scenario of this stability return scenario, right? And quick
Mhm.
deal. So oil prices and then bond yields. And again, bond yields. I'm asking not because our community is very interested about the yields. Or investing in bonds with yields, but because it puts pressure on the economy and the
For
world
sure.
market, right? And especially when most of the bonds are U.S. bonds, and then most countries invest in the U.S. By buying their bonds, and it affects it has a triple effect to other countries as well. So if you
100%.
can let me know about your ideas about in this case of scenario, what is the oil price is going to be? Is it going to settle and go down or up or stay like this, or is that what is going to happen with the bond yields in this case?
For sure. Great question. And for our Muslim investors, obviously we don't invest in fixed income products. We're not bond investors unless the Sharia compliant bonds. But it's important for us to know as investors in general, because the global economy is very tied to the United States financial economy, to that financial system. And that's a financial system that's built on government debt, which means bonds, bond yields, right? So you have to have some understanding of how that works and what's going on in bond markets, especially US government bonds. If you want to see how is the market going to move, how is the economy going to move. So even though we don't invest directly in those bonds, you have to know how they work. You won't understand finance until and unless you have some understanding of what's going on in bond markets. So yeah, like I said, inflation and oil prices are if our oil prices, if we reach a peace settlement, especially sooner, will come down from the peak they're at. So right now, it's pricing in worst case scenarios, as well as like there's a million investors with many different thoughts, and that pushes the price up, especially because it's risky. If the risk goes down, a negotiated settlement is reached, which people believe will hold, which people believe is credible. Oil prices will come down from their peak, but like we said, there's still some damaged infrastructure. There's still a lot of issues. So oil prices will be higher than they were before the war.
Mhm.
What that means is oil is going to be more expensive, right? Very simply. And who's buying this oil? Is different nation states are buying this oil and gas to run through their economy. especially a lot
Yeah.
of Southeast Asian economies depend on oil going through the Strait of Hormuz.
Mm-hmm.
These and oil is, the global system is oil is priced in US dollars, the petrodollar system.
Mm-hmm.
So these countries, if the price of oil goes up and they need to buy this oil and gas, they're going to need more dollars because the price just went up. If
Mm-hmm.
they need more dollars, where does the country get more dollars, right? So every country, every central bank holds a variety of assets. So your central bank, the United States Central Bank, Pakistan, India, Taiwan, Japan, they all hold multiple assets. They'll have gold, they'll have some in US dollars, literally, and a lot of them will have a large chunk of their assets in US government debt. So those are those bonds that the US government issues, which are
Mm-hmm.
priced also in dollars.
Yeah.
So governments will, if they need more dollars, they'll take their assets, which are priced in US dollars, like bonds, and they'll sell them. So markets will buy those bonds and they'll give these governments US dollars, which they'll use to buy oil. Now, what this means is this is going to have a ripple effect because, like I said, the whole global financial economy, especially the United States economy, runs on bonds. So the supply and demand of bonds is super, super important. If these countries start selling their bonds, what that means is there's a bigger supply of US bonds, which means they become worth less, right? The more supply there is, the price goes down.
Mm-hmm. Mm-hmm.
If the
Mm-hmm.
price of bonds go down, then when the US government needs more money and how it raises money is by issuing bonds, it's going to have to issue bonds with a higher yield. So this
Mm-hmm.
this might this might be very confusing for some people. So just to explain, right? Let's say the US government spends $200. This is just an example, and it raises $100 in taxes. So it's short $100. So for those $100, what it says is, I'm going to give you an IOU, a bond. I'm going to
Mm-hmm.
give this to you. You'll give me $100, and I'll pay you it back with interest. So that's what a bond is.
Yeah.
But what's going to happen is if the price of bonds go down, people are selling bonds, the US government will have to say, instead of I'll give you with 5% interest, I'll pay it back to you with 10% interest. So the
Yeah.
United States government is going to have to pay a higher and higher premium on its bonds to attract more people to buy that bond. And this can be disastrous. This because the United States already has a very high debt burden. What this means is it gets harder for the US government to pay back on its debt. That's one problem that happens.
Mm-hmm.
The second thing that's going to happen is if you're an investor, right? Don't look at the just Muslim investors. We don't buy bonds anyways, right? But the majority of the big banks, the hedge funds, the pension funds, and non-Muslim investors, they're going to be like, okay, I can buy stocks in the stock market, and those can go up and down. On average, the S&P will maybe give me a 7% return, but maybe the return on the US bond goes up to an 8% interest rate, right? Or even a 5 or a 6% interest rate, but the price goes up and it's a very secure one. It doesn't go up and down, it's fixed income. So
Mm-hmm.
why would I risk the stock market when I can just buy more US debt?
Mm-hmm.
Um, and so when that happens, stocks will go down because people
Yeah.
are pulling their money out of stocks and going into the bond market.
Mm-hmm.
When that happens, a lot of people are going to be losing money, right? The common retail investors don't typically have a large amount of stocks. They're going to have bonds, but they're going to have stocks. So their wealth will go down. Their wealth goes down, their money goes down, they pay less capital gains tax. What that means is that the US government will likely make less money in taxes.
Mm-hmm.
If the US government makes less money in taxes, it's going to have to issue even more bonds, right? So, like we said, let's say it has
It's
to
it's
spend
paid,
$200.
right?
It used to earn 100 from taxes. Now it's only going to earn 80 from taxes. So it has to issue even more bonds. And if it has even more bonds, it has to push the yield even higher. So it becomes like a cyclical pattern, which is called a debt spiral. So the more
Mm-hmm.
debt you issue, the harder it gets to pay off. So it just gets worse and worse and worse. And that's the worst case scenario right now, if that plays out that way.
So this was like very detailed explanation of
Yes. If
it's kind
anyone
of
has
like
questions, please
yes,
leave them in the comments.
yes, we can explain it again because I will be doing this segue, and thank you so much for explaining at the beginning because we'll come back to these terms, right? So as
Mhm.
we go segue to scenario 2 or 3, this is a little bit more applicable to the situation, right? In scenario 1, maybe there's going to be really good solution, and we're going to get out of it like by the markets all trying to stay positive, governments helping to like do CPR to the economy, I would say, to the world economy, bring it back, and then try to revive it, and everyone stays positive. This is a little bit more positive. But in scenario 2 or 3 are and more situations which is close to this spiral debt situation, which we will apply them now. But thank you, Shah, for explaining all of this, how this happens as the whole chain. You might have missed it, but we can bring it back and explain it again in a little bit more summarized version. But Shah, thank you so much explaining. Anyone who's going to watch this again, it's going to be one of the best, I guess, explanations I've seen, and I've known it, but the way that how Shah explained it was amazing. Thank you so much. And again, one quick thing, I like to distract a little bit people when they're listening in very focused, and they may get overwhelmed. So I want to share that we have people joining from Qatar, India, and some other places. And again, I'm reminding, if you joined just now, please leave where you join in the comments or in the chat of YouTube or other places. Please leave where you're joining from. It helps us to see whose audience, where they're joining from, and leave your questions if you want to ask. And I believe Mohsen Hassan is one of our very loyal joiners of this market talk with Musaffa. He always the brother joins always from India, and then we're very pleased to have him on all our call these, and then he's active as well. I know that the other people join as well, but please leave in the comments where you're joining from. And then now we move to the second scenario, right, Brother Shah? So that situation, that very difficult situation for everyone, for governments, for markets that you describe, I believe it's more applicable in the cases where we have a brother from Ghana, subhanallah. So in the case of where we drag on this negotiations for another 2 or 3 weeks, and then Strait of Hormuz is used as a leverage and stay closed, so that fertilizers are not reaching the proper places where the food can be grown, which is exactly the one of the best times right now in the rest of the world. Not everyone uses greenhouses and then the places that they can grow food, and even in those places you need it. But and in many occasions you need fertilizers to grow food, right? It is going to have a effect after this all happening during the summer, or even season of the harvesting. It's going to affect the world economy, like a world food bank, etc. So that is going to affect. And then and this, because of the fertilizers, and then again oil and gas, which is 20% of the market, and then this going to have another effect with also the prices are going even more higher. You know that we even in the scenario one, we said that these prices may stay higher, but then this one, it's even growing, right? So for another 2-3 weeks, and then can the market bear this heavy negotiations going longer?
For sure. Oh, do you want me to go, or sorry?
Yes.
Sorry.
So is the market is okay? What is going to happen in this scenario number two? Is there going to be even heavier effect?
For sure, for sure. Yeah, I got a bit excited with my explanation before, but yeah, that in that prior scenario, everything I explained about how the price of oil goes up, governments need to sell their US-backed assets, right? If we see peace in the earlier scenario, prices won't go up as much. So there might be some offloading of US Treasury debt, but not a lot, right? They only need a little bit to cover it, and then markets might adjust. Maybe they'll reduce demand. For example, you see countries like Pakistan where they're like they're saying only a few days in person, take some days off, reduce commuter spend on oil. So they can do things to dampen demand a little bit as well. However, in the scenario that the price crisis goes on, the war goes on, pressure increases, this stays protracted for longer, then oil prices will continue to rise. And oil and gas prices, as they continue to rise, as the supply is restricted, as the supply of natural gas is restricted, as the fertilizer and the food industries get hit, you're going to see inflation go up in every way, not just oil and gas, jet fuel, travel, food costs because of the fertilizer costs going up. So there's going to be systemic pressure on inflationary pressure in pretty much every economy in the world. And that's going to have, first thing that could happen is the early scenario we discussed, where as the price of oil goes so high, governments need to pay it. They're going to offload their US Treasury debt. They're going to offload US bonds to get US dollars so they can buy more oil. And that could lead to that spiral as we were discussing earlier.
Yeah, yeah.
Um, so yeah, so that's a major issue, and that can lead to a few different issues. One is hyperinflation, right? That issue happens. Inflation goes higher and higher. Central banks can't control it. The price of the money just gets worth less and less and less, like we saw in Germany around World War II. And your money becomes worth less and less and less. So that's one scenario. Another problem that governments are going to face is this is a twofold shock. In one sense, it's that inflationary pressure. And what central banks usually do when inflation happens is raise interest rates.
Mm-hmm.
But what you usually do also is if the economy is slowing down, you don't raise interest rates. So now central banks have to balance both of those things because the economy is slowing down because we're not getting oil and gas, which powers the economy, but inflationary pressures are higher. So do I cut interest rates? Do I hold them steady? Do I raise them? There's no perfect answer, and it's going to get worse the longer this goes on. If it's a short-term conflict, like in the first scenario, central banks will maybe suffer a little bit. Maybe they'll hold rates, but then when the let's say a peace settlement is reached, then things will normalize. But if it keeps getting worse and the price of oil keeps going higher, central banks are stuck. Do we cut rates? Do we, what exactly do we do? So, and then let's go back for a second, and let me know if I'm going in too much detail here. But let's go back to a second to the bond market. If governments, non-United States governments, are and pension funds, hedge funds, sovereign wealth funds around the world, if they start selling U.S. Treasury debt, the supply of debt increases. So one thing the United States government can try to do to fix this and to rein in bond yields is create demand. And so in order to create that demand, what the United States government has done in the past in similar situations is quantitative easing, which means that the United States government might say, okay, what we can do is print more money and we'll use that money to buy the bonds. So we are going to create a sort of artificial demand. Now, what the problem with that is there's a few different ways you could do it, but you have to buy the bonds from the people who hold the bonds, right? So what that will mean is, so once in 2008, what happened is there was mortgage-backed securities. The government stepped in and bought those from the banks. That wasn't very
Just
inflationary. Sorry,
before
go
you
ahead.
continue on this one, which is very interesting, and again, everyone is listening. I want to give them a little bit of like focus, right? Because
Right.
they might join and then they're listening bonds. And so to share with everyone and remind back, so we're looking at the scenario 2 and 3, which is are a little bit worse on the spectrum, right? The first one we talked about, like very quick deal, and then we put the market, the world economy back to where it used to be before the war. Now, this scenario 2 and which 3 we will come back, which is continued war. In this 2 and 3, what Shah is sharing, that is when he said 2008, I wanted to remind everyone. So we're talking here about the crisis, right? So everyone has to understand that here's a more crisis situations coming. Again, these are our own views. We're not advocating, or we're not saying that this is going to happen 100%. Of course, the governments try to resolve it, as in 2008, everyone jumped in to address this issue, right? So the world economy crashing, etc. So that's what Shahs are giving a few options how the Federal Reserve banks and the governments are going to react, right? Printing more money to address the problem. And again, inflation though going up because you're printing more money, right? And then the government has different ways of printing more money, and then everything else Shah is trying to explain. But we're right now at the scenario 2, where negotiations are dragged for like more than 2-3 weeks, and then Strait of Hormuz still remains closed. But I don't know where we're going to end when the war continues, right? Inshallah. Brother Shah, you can
Sure.
uh, uh, get back to explaining about the
Yes.
printing money point.
Of
Yes.
course. Yes. And one thing also, like you said, like these are just a few possible scenarios. One thing I think people shouldn't discount is creativity, right? Like in 2008, there was a financial crisis. The government stepped in with kind of a creative solution: print money, buy it back. Um, I'm not saying it was the perfect solution, but it was a creative solution. So there might be a creative solution that we're not aware of because we're just thinking in historical terms. So these are only a few possible scenarios. They might be likely. I'm not saying they're confirmed, but there's other things that could happen. But right, to go back to it, so what the government could do is if there's more supply of bonds, what they want to do is create more artificial demand, sort of create more demand for those bonds. One way of doing that is printing more money, which is called quantitative quantitative easing, or QE. They did that in 2008 when the financial crisis happened, and that didn't cause inflation because they were buying assets from the banks, right? Directly from the banks. So the money just went straight to the banks that needed it, kind of. They offloaded the dangerous instrument, which is the MBS. But what could happen instead is, because this time they won't be buying just from the banks. So they'll be buying the bonds from pension funds. They'll be buying the bonds from sovereign wealth funds. They'll be buying the bonds from hedge funds. And these are companies, these are corporations, these are investors, institutional investors. And when they get the money from the United States, right? So the United States buys the bonds from them. So they get money. What do they do with that money? They're going to go and put it in the bank. So when they put it in the bank, that creates a deposit in the bank. And the way the financial system works is when you put a deposit in the bank, that creates more money. The bank will create
Yep.
more money. So there's going to be even more money flowing in the economy. So that's going to be inflationary. When there's more and more money in the economy, but the economy isn't generating more output. So let's say the economy hasn't grown. There's not more factories. There are not more cars being made. Nothing has changed except the amount of money. That's inflation. So the problem with printing more money or quantitative easing is that in this scenario, it might help with the bond market directly, but it's going to be highly inflationary. And there's already the inflationary pressure if the war keeps going on for a few weeks or months or even longer. The oil price is already an inflationary pressure. If the government prints money this way, it's going to cause even more of an inflationary pressure. So it's kind of boxed in a little bit in that regard.
Yeah, thank you so much for going into another step of explanation. We established how the bond market works, and now we established how inflation would affect the bond market. I guess this is one of the most educative market talk with Musaffa that I have had. Alhamdulillah, thank you so much for going to into so much of detail, Brother Shah. And then
Of
we have
course.
some people joining more from India, from Canada. So please, again, share where you're joining from. And if any of these discussions are not clear or interesting for you that you want to ask follow-up question, please ask those questions, and we're here to answer those. Brother Shah, I want to take you to the third scenario, which is the most groovy, the most, I guess, dangerous area where we're gonna go. It's not negotiations dragged, but actually the war starts, where it not only that if negotiations continued, but there's no war, at least markets behavior, or if we can say emotion of the market, would stay a little bit hopeful. But in the case of the war resumes without clarity when it's going to end, I believe that also affects the emotional aspect of the market, right? The people, because they don't know where it's going. If the negotiations drag, but they still, people think, or like investors think, okay, at least we get out of it, they stay hopeful. But when the war resumes and then it continues, I guess for a month or two, then what happens in that case?
Great question. Yeah, the longer this goes on, first of all, the dynamics we discussed earlier will be worse. So those same things, the
Mhm.
worst possible versions of those will happen. But
Yeah.
then, like you said, investors themselves, right? Global investors, they'll have to adjust. It's one thing to say, okay, this is a spike, it'll normalize in a few months. You always hear investors say commodities are mean reverting, which means they go back to normal over time. But if this is going to persist over months, maybe even longer than a few months, then investors are going to realize this isn't mean reverting right now. I have to move my investments out of there and somewhere else. So
Mhm.
they're going to be pulling their investments out of oil and gas in the Middle East. They're going to be pulling it out of fertilizer. They're going to be investing in other industries. They're going to be pulling it out of the airline industry. They're going to be pulling it out of all of these industries and these regions, which are going to be heavily affected. Um, And then again, like we discussed, like it's going to get more and more expensive for central banks, for governments, and it's just going to lead to all of those dynamics that we discussed earlier as well.
Okay, great. Thank you for. So it's going to be even worse, basically, than the scenario number two. Okay. So and then we might end up in probably in the crisis or type of crises that the markets and the governments have to cope with, right? And people
For
have
sure.
to watch for that. Now, across all these three scenarios, what are the key indicators that investors should watch so that they understand which direction we're heading?
Great question. One thing to watch is honestly the news. And one thing we always say is like, be patient, be calm. You kind of have to look beyond the news a little bit. So don't just see a headline and panic and make a decision, because it's a volatile time, right? You hear one headline one day, the exact opposite the next day. It's the nature of politics, the nature of negotiations, but watch the news keenly, and you have to judge what is being said and how credible is it, right? How believable is it? So is there a negotiation being reached, and do I think this negotiation is going to last? That's one thing to look at. The other is, I would say, look at transit calls for tankers through the Strait of Hormuz. What that means
Mm-hmm.
is, keep up not just on the news about negotiations, but right, even if they say, hey, we've reached an agreement, look at the actual news for like, are tankers going through the strait?
Mm-hmm.
Because one thing that I also expect to happen, that happened a little bit when the ceasefire was first announced, is even if they announce a ceasefire and even if they announce an agreement, actual tankers might wait a bit longer, because it's their lives at stake, right? It's their
Yeah.
ships, their cargo. They might say, actually, let me wait a little bit because this is so volatile. This has happened before. I'll wait a little bit. So you'll know it's like believable and things are going to get better when we actually see the strait open, when we actually see tankers go through the strait. And then number three, which is related to those things, is the oil prices. But again, don't be confused. They go up and down a lot. So contextualize what you see in the oil price with what you see in our tankers going through. Has an
Mm-hmm.
agreement been reached? Look
Mm-hmm.
at those three things together, and you'll have a good idea. Like, okay, if they've reached an agreement, do people believe this is an agreement that will last? So that's what I would say. Is look at those three things in connection with each other.
Great, thank you so much. So we're coming towards the a little bit end of our discussions, which has been very interesting. I will actually ask one or two very quick questions, but we have from our loyal listener to Market Talk with himself, which is brother Mohsen Hassan. If we try to answer his question quickly, brother Shah, and I have one or two, and then we can start showing a little bit of our platform, inshallah.
Sounds good.
Can you see his question? Just
Yes, I can.
let me read it through.
Of
Can
course.
you tell us how inflation is calculated? How does this calculation for any country?
Great question. So the people who do the calculation for any country are your country's central bank or state bank. So the state bank, for example, I'm from Pakistan. The State Bank of Pakistan collects this data, does that analysis. The central bank in the United States does it for the United States. So every country's own central bank, which is the government side that runs the economy, runs the financial system, monetary system, they're the ones who collect this data typically and do this analysis and see what inflation is, where it's going, up or down. So that's on them. And how it's calculated is each government will create a theoretical basket of goods. So they'll think, okay, if I am your average citizen of the United States or Pakistan or Malaysia, what are we in general spending our money on, right? So they'll make a fake basket just to like have an idea, like, okay, this person buys 6 eggs a week or 12 eggs a week, and they spend this amount of money. They need this many liters of gasoline. They buy one iPad every 8 months, for example. So they'll make like a fictional, just like an example portfolio or a basket of what does the average person here spend their money on, right? And then they look at prices for each of those things. And the more important things will have more weight. They'll be more a bigger part of that equation. So they look at how the prices change. So for example, let's say there's 10 things a person buys, and then the price of all 10 of those go up from month to month. They'll say, okay, the price was $100 for each of these in February. Now it's March. The price for everything is $200. So they'll say, okay, inflation went up 100%, for example. So that's how they do it. They make a basket of goods that people use, and they see how the price for that overall basket goes up and down. And if the whole basket goes up on average, that means there's inflation. And how much it goes up is how much inflation there is. I hope that helps.
Yeah, that was very, very good explanation, Brother Shah. Thank you so much.
Of course.
So yeah, I guess we can summarize with the very last question. But again, I want to draw a little bit attention because we talk to our Muslim brothers and sisters, right, who are Sharia conscious. They look at the market with a Sharia conscious perspective. And again, our investors who are investing, if they're investing in halal stocks, which is they can check on the Musaffa's um, the stock screening, ETF screening filters, which I will show inshallah. So when they're looking, they're looking try to avoid companies with the highly leveraged companies, right? Usually, when you invest in halal stocks, they're always less leveraged the companies, right? So they have less interest involved in their business, and that it affects them less. These all kind of crises affects them, but it affects them less, right? So in that case, Sharia conscious Muslim investors win in most of the cases. Again, knowing that all the background, what would you, Brother Shah, if you had to leave the investors, Muslim investors, with one principle to navigate all these three scenarios, what would that be?
I have two things. One is invest halal always. Uh,
SubhanAllah.
the number
Yes.
two is stay calm and stay aware. And
Yeah.
the reason I'd say invest halal always is, like you said, we can't invest in companies which are too highly leveraged. So they can't have a high degree of interest bearing debt. What this means is this to some degree, obviously, when it's a systemic shock, everybody's going to get hit. Nobody's completely clean. But because this is a shock tied to bond yields and tied to interest rates, and we can discuss the relationship between interest rates and bond yields another time because that's a very long explanation.
Yeah.
But it shields you from that because you're the companies you invest in don't have a large amount of interest bearing debt, so they're not as strongly affected by these things. So invest halal always because it shields you from these sort of major financial blowbacks that other companies are going to face. If you're a highly leveraged company, your treasury department is going to be on fire in the coming months if this keeps on going. But a company that has low amounts of interest bearing debt is going to be more secure in that respect. So that's one thing. And then again, as we always say, stay aware, stay up to date, but stay calm. The worst mistake investors make generally is being too emotional, is panic buying, panic selling, making decisions based on panic. Stay calm, trust in Allah, make a smart decision as best as you can, and inshallah everything will be okay.
And invest in halal stocks.
Invest in Allah,
Yes.
exactly.
Yes. Thank you so much. So this is really good. And I would recommend the same thing to Muslim investors, Sharia conscious investors. You can see that our team put the discount code Market Talk 410 to get 10% of the subscription. I would like to show a little bit. It will take not more than 1 or 2 minutes. Our platform where you can actually check less debt, less interest baked into the company's operations through our stock screener and then advanced filters. If we can put my screen on, Sister Nafisa Khan, she's helping us at the background. SubhanAllah. Thank you so much. So if you see here, so you basically see here US investing. If you want to invest in US stocks, we launched our platform in a global halal investing platform. So you can come and invest based on your risk profile. We also give you some recommendation scores on each stocks that you would like to invest on. But main point from today's call that I wanted to share that Muslim investors in these kind of scenarios, they benefit from halal stocks because the stocks, the companies whose operations are halal, they have less interest involved in their business. That means when the shock comes, they are affected less, right? So if you look here, there's this filters you can filter by. So if you go Musaffa filtering aspect, of course you can analyze from all other points, from the general information, price, volume, trading metrics, financial performance, etc. But for the halal stocks, if you want to find any, if you during this crisis times, if you want to focus, we recommend you, of course, to look at the interest bearing or not interest bearing. So if you take, of course, this is going to be the halal stocks you're investing, right? So, and then let me maybe pick A plus. These are mostly very strong in terms of their halalness, in terms of their share compliance. But again, if you want to specifically say revenue has to come from 98 up to 100 from pure. It doesn't mean like you're investing in something non-halal, but there's that's why we built the purification. You can easily purify your stocks, even if there's a permitted amount of non-halal sources are involved. The Musaffa made it so easy for you so that you can instantly purify, calculate, and then donate that amount, right? So now look at the interest-bearing debt. If you want to say that it should not be more than 5 or 15% of its market cap, which is actually up to 30% is allowed, but you keep it even less. Imagine that they're only 15% of their market cap. The company's market cap is involves interest. So this is, or even you can make it 10. So we have 210 companies. You can even make it, let's say, you keep it at 10%. So you have 129 companies. These, you can see their interest-bearing debt is very low. It's only 7% of the market cap here, or 5 or 6% of their market cap, etc. So you can actually click this one, and it aligns for you. So you have this all very strong companies that involves less interest-bearing debt, less high yield involved in their business and operations, and they usually survive these kind of crises. Thank you so much. It got a little bit longer to today's, but it's worth it because it was so educational. I believe people are going to enjoy from this, and then we're going to break it down and cut it. Maybe we'll share more like educational shorter videos. Alhamdulillah. And we really thank Brother Shah for his time, for walking us through this all steps that involved in the economy when world economy reacts to these kind of things, to these kind of crises. So thank you so much for everyone's attention. We end from here. We wish you the blessing weekend, and then very, very good start of the next week, inshallah, with some good results with this Iran-US talks and negotiations, inshallah. And thank you so much, Brother Shah. You have a wonderful rest of the day.
Thank you.
Thank you.
You as well.